the United States finds itself hurtling towards a precarious financial precipice, as its national debt to GDP ratio exceeds a staggering 130%. This alarming figure signals an unsustainable trajectory that raises profound concerns about the nation's economic stability and vitality. As the debt crisis looms ominously, it becomes imperative to dissect the key elements contributing to this perilous situation and to scrutinize the role of modern monetary theory in exacerbating the problem. Moreover, it is essential to elucidate the potential ramifications that this crisis may inflict upon the broader U.S. economy, underscoring the urgency for informed action and prudent policy measures. One of the pivotal points of contention revolves around the widely acknowledged threshold of 90% debt to GDP ratio, beyond which economies are prone to experiencing a drastic slowdown. Alarmingly, the United States not only surpasses this critical threshold but does so by a considerable margin. This breach of the threshold underscores the gravity of the situation, prompting urgent reassessment and strategic intervention. Furthermore, the efficacy of increased borrowing as a stimulus for economic growth has significantly diminished, with each additional dollar borrowed yielding progressively diminishing returns in terms of economic output. This troubling trend poses a formidable challenge to the nation's long-term economic resilience and vitality, necessitating a paradigm shift in fiscal policy and economic management. Moreover, the deleterious impact of burgeoning debt levels extends beyond mere fiscal constraints, permeating into the fabric of economic productivity and consumer behavior. High levels of indebtedness compel individuals and businesses alike to make choices that stifle productivity and impede growth. Consumers, burdened by debt, often opt for less expensive goods, curtail discretionary spending, and defer significant purchases, thereby exerting a palpable drag on economic activity. Additionally, the specter of rising interest rates looms ominously, as attempts to combat inflation through monetary tightening further exacerbate the debt burden, precipitating a vicious cycle of economic downturn and rising unemployment. In navigating this treacherous terrain, policymakers must adopt a multifaceted approach that addresses the structural deficiencies underlying the debt crisis while fostering a conducive environment for sustainable economic growth and prosperity. Proponents of modern monetary theory, MMT, advocate a seemingly appealing notion that debt becomes inconsequential for nations possessing the ability to issue their own currency. This theory proposes that governments can simply print money to cover their expenses, without facing the risk of default. However, such a simplistic approach overlooks several critical dimensions, exposing inherent flaws that render MMT a false promise. Foremost among these concerns is the disregarding of inflationary pressures and the looming specter of hyperinflation. By indiscriminately increasing the money supply without corresponding economic growth, governments risk triggering runaway inflation, undermining the purchasing power of citizens and destabilizing the economy. Furthermore, the ramifications of MMT extend beyond domestic borders, exerting a profound impact on the international economic landscape. The unfettered printing of money inevitably leads to a depreciation of the national currency, weakening the US dollar's standing in global markets. This erosion of exchange rates not only diminishes the purchasing power of American consumers but also precipitates adverse consequences for international trade and investment. Moreover, MMT's myopic focus on domestic considerations neglects the interconnectedness of the global economy and the United States' pivotal role within it. Foreign lenders, upon witnessing the reckless pursuit of MMT policies, may lose faith in the stability and reliability of the U.S. economy, triggering a cascade of economic turmoil and escalating costs for imported goods. In essence, the allure of modern monetary theory proves illusory upon closer examination, as its proponents overlook fundamental economic principles and geopolitical realities. While advocating for an ostensibly painless solution to fiscal challenges, MMT fails to grapple with the pernicious consequences of unchecked money printing. Instead of embracing this flawed doctrine, policymakers must adopt a more nuanced and balanced approach that acknowledges the intricacies of economic interdependence and prioritizes sustainable fiscal practices to safeguard long-term prosperity and stability. The looming consequences of the burgeoning debt crisis present a dire outlook for the United States economy, with far-reaching implications that extend beyond its borders. Foremost among these concerns is the specter of reduced economic growth, as the stifling weight of high debt levels imposes a significant drag on the nation's economic vitality. With resources diverted towards servicing debt rather than fostering productive investment and innovation, the prospects for robust and sustainable growth become increasingly bleak. This stagnation could potentially manifest as a protracted period of economic malaise, lasting for years or even decades, eroding the nation's competitive edge and diminishing its standing on the global stage. Moreover, the attempts to address inflationary pressures through aggressive interest rate hikes risk precipitating a severe economic downturn, plunging the economy into a deep recession. Such measures, aimed at restoring price stability, may inadvertently exacerbate the underlying structural imbalances and amplify the adverse impact of the debt burden. As policymakers grapple with the delicate balancing act of managing inflationary pressures while safeguarding economic stability, the specter of fiscal distress looms large. The government may find itself constrained in funding crucial programs and services, as mounting debt obligations consume an ever larger share of the national budget, exacerbating social inequalities and exacerbating public discontent. Furthermore, the ramifications of a potential financial crisis in the United States reverberate across the global economic landscape, exerting profound impacts on international trade dynamics and geopolitical relations. A precipitous downturn in the world's largest economy could serve as a catalyst for a broader global economic downturn, disrupting supply chains, dampening investor confidence, and straining diplomatic ties with other nations. As the interconnectedness of the global economy becomes increasingly apparent, the imperative for coordinated action and prudent policy measures to mitigate the adverse consequences of the debt crisis becomes all the more pressing. Addressing the pressing challenges posed by the impending debt crisis demands a comprehensive and multifaceted strategy aimed at restoring fiscal stability and fostering sustainable economic growth. At the core of this endeavor lies the imperative for stringent spending cuts, compelling the U.S. government to embark on a path of fiscal austerity to rein in burgeoning expenditures. However, the prospect of implementing such measures looms large with political complexities, requiring policymakers to navigate a delicate balance between fiscal prudence and safeguarding essential public services. Nonetheless, the imperative for decisive action underscores the need for bipartisan cooperation and a shared commitment to prioritizing long-term fiscal sustainability over short-term political expediency. Furthermore, the daunting fiscal landscape necessitates the exploration of revenue-enhancing measures, including the imposition of tax increases, notwithstanding their political unpopularity. As policymakers confront the stark reality of escalating debt obligations and persistent budget deficits, the imperative for equitable burden sharing becomes increasingly apparent. By adopting a balanced approach that combines spending cuts with targeted tax reforms, policymakers can alleviate the strain on public finances and lay the groundwork for a more resilient and equitable fiscal framework. Moreover, the pursuit of fiscal rectitude underscores the imperative for comprehensive economic reforms aimed at unleashing the nation's productive potential and stimulating long-term growth. In addition to fiscal measures, the imperative for structural reforms to incentivize growth and enhance productivity emerges as a linchpin of the way forward. From streamlining regulatory frameworks to investing in innovation and human capital development, the pursuit of economic revitalization demands a bold and visionary approach that transcends partisan divides. While the implementation of such reforms may prove time-consuming and arduous, their dividends in terms of bolstering competitiveness, fostering job creation, and enhancing resilience to external shocks cannot be overstated. By embracing a holistic agenda that encompasses fiscal discipline, equitable taxation, and forward-looking economic policies, policymakers can chart a path towards a more prosperous and resilient future for the United States economy and its citizens. The looming U.S. debt crisis presents a formidable challenge that cannot be overlooked or underestimated. The potential ramifications of inaction are dire and could result in catastrophic consequences for the nation's economy and its citizens. While modern monetary theory, MMT, may offer seemingly enticing solutions, its promises prove to be illusory upon closer examination, failing to address the underlying structural imbalances and risks of fiscal irresponsibility. Instead, embracing a path of responsible fiscal policy emerges as the only viable course of action to avert economic ruin and safeguard long-term prosperity. By implementing prudent spending cuts, exploring revenue-enhancing measures, and undertaking comprehensive economic reforms, the United States can mitigate the looming threat of the debt crisis and chart a course towards sustainable economic growth and stability. Moreover, the urgency of addressing these challenges cannot be overstated, as timely action holds the key to mitigating the adverse consequences and maximizing the country's prospects for a brighter future.